With the war escalating between Russia and Ukraine, I'm sure you're beginning to feel the repercussions here at home. How long will this market volatility continue? Hi, I'm Jeff Jr. with Trajan Wealth, and welcome to our monthly market review. We're sharing our insights here and expert financial advice, so please like, share, and subscribe. Now, current upheaval in markets has had some serious impacts on anyone who owns stocks. Markets are being rattled all over the world because of the war in Ukraine. Plus, the Federal Reserve officials also signaled a March rate hike is still in the plans, and inflation, well, it climbed for the 5th straight month. Now is probably not the best time to look at your 401k or your IRA statement. Checking those balances is only going to build anxiety. Now, I'm sure you already know oil is Russia's most important export, and disruptions are increasing gas prices here. California, as an example, is around $7 per gallon. Most other states are around $4, and many are pushing $5 per gallon of gas. But both Russia and Ukraine are also large agricultural suppliers. They sell wheat, rye, barley, and other grains to Central Asia and the Middle East. Agricultural disruptions could send global food prices much higher, which in turn then puts pressure on the U.S. consumers. In addition, bottlenecks in critical metals from that part of the world could worsen the current semiconductor shortage and further push up prices of cars, electronics, and other big-ticket items. So what's our prognosis, you ask? So clearly, being more cautious about your spending can help keep money in your wallet as prices climb. But what about the market, you ask? Uncertainty and volatility look like they're not ending anytime soon. So here are my top 4 tips on what to do when the market is volatile and how best to protect your money. So number 1, focus on the long term. It's easy to look at your portfolio right now and panic. I get it. You may want to cut your losses, sell now, and stuff what's left of your money under your mattress. Don't do it. Selling just based on current market movements is an easy way to make your losses permanent. Time spent in the market is far more important than trying to time the market. Most big up days occur within 2 weeks of big down days 60% of the time. Pulling your money during a drop may cause you to miss out on some of the market's biggest single-day rallies. Focus on your investment's future, not the current market volatility. History shows you're more likely to make more keeping your money in the market than out. And also know no one has a crystal ball, but odds do favor 10-year in, not out. Number 2, keep your emotions in check. Volatility in the market triggers our instinctive fight or flight reaction. And why wouldn't it? You know what a market drop means for your investments. It is normal to feel an emotional reaction to major market events. Behavioral studies have proven that you will act irrationally making investment decisions under these type of conditions. Don't let your retirement goals veer off track because your emotions overrule your logic. That's why Trajan Wealth fiduciary advisors are here to help you make your investment decisions from an objective perspective. Number 3, make sure there's diversity in your portfolio. Putting all your eggs in one basket is never a good idea, especially not with your nest egg. Sometimes a market dip is a wake-up call that you're more at risk than you actually thought. Now, since we can't predict market ups and downs, investing in various asset classes acts as a buffer against market volatility. Ideally, one asset stabilizes the portfolio when another one slips. And Trajan Wealth portfolios are designed to your long-term goals. Now you may be thinking, I'm pretty sure my portfolio is diversified, but why am I still taking a huge hit? And that brings me to my last and probably most important point, which is number 4. Put this into context and know sometimes there is just nowhere to hide. Even with the best portfolios, there will still be losses. This is the nature of investing. And also know that geopolitical events, such as the one we're in, are generally short-lived. After Pearl Harbor, as an example, arguably the worst war our world has ever seen, which was World War II, our stock market took 143 long days of going down to bottom, but it was higher only 307 days later. So if you're investing for more than a year, take solace knowing this is part of the trade-off with investing, and know our markets are resilient.